So our presentation today is on acceptance rates, but really we're going beyond that. We're going to conversion rates as well. So acceptance rates would just be ensuring that the issuing banks are not declining transactions and that you can maximize your sales volume. But conversion rate is making sure that when customers enter your store, either online or in store in bricks and mortar, that they stick there and that you're not losing transactions. So we're focusing on both areas. Now, obviously, increasing acceptance rates and increasing conversion rates, what it will do is increase revenue. But should you have a positive gross profit, as I'm sure everybody here does, then you should also see improved operating margins and improved bottom line profit as well. So really, any treasurer, anybody interested in revenue or profit should be interested in maximizing conversion and acceptance rates. Okay, so obviously we're speaking about acceptance rates, and it is, it's relevant for whether you're in store or whether you're online, but particularly we notice it's a problem for retailers who are operating online, and because of that we've noticed it's an increasing problem. So if we look at the graph here, and this is the size of the European online spending sector, in 2011 there was 240 billion euros of online spending in Europe. By 2016, that had increased to more than 500 billion. So really, it's increasing at an increasing rate. A couple of reasons for that. I mean, obviously economic growth, but also cannibalization of bricks and mortar retailer, and we don't think that's anywhere near maturity yet. So we think 10 years ago, online acceptance rates and conversion rates, maybe not so much of a factor for a lot of merchants. Now, pretty much every major merchant has an online sector. They're selling online, and this is really, really important for them. We've also got a little bit on the composition here, so you can see that, I mean, as you'd expect, the UK, France, and Germany are, the largest largest online spending. But the UK is really large, so anybody that has a lot of spending in the UK is going to be particularly relevant for that. Although, as I say, it'll be relevant for everyone. So we're gonna discuss through 9 points, and the first of this is knowing your customer payment preferences. So this is to do with alternative payment methods, and we find these differ significantly by country, and we've got a graph, or a number of graphs, here to show that. So in the UK and in France, fairly typical, there's a lot of online spend on credit cards and on debit cards, and a lot on e-wallets, the majority of which will be PayPal, although we're increasingly seeing the likes of Skrill and Nutella gaining market traction. But it's very, very, very different in markets such as Germany there and the Netherlands. So in Germany, we have Software banking, and in the Netherlands, there is Ideal. And you'll notice that is north of a 70% market share for the bank transfer Ideal in the Netherlands. So natural thing then is in the Netherlands, you need to accept Ideal, and in Germany, you need to accept Software. The answer, probably yes, but not necessarily. The Netherlands, what we've observed, very, very high market share for Ideal at medium to high transaction values, but at lower transaction values, Ideal, maybe not so popular. So it's not just simply a case of saying, in the UK you do this, in the Netherlands you do that, in Italy you do that. It varies, so it can vary depending on your transaction profile. It varies depending on which sector you're in. You really, really need to think about what payment methods you're accepting in each country. So I suppose the next thing you'd say to that is, why don't I just accept them all? And, in many ways it has, it's a perfectly logical way of thinking about it. What I would say is, if you want to accept every payment method, you're probably going to accept 100 or more if you're operating across a number of countries. Awfully the high transaction costs associated with negotiating those contracts. Also, if you only have a smaller amount of payment methods accepted, it means you've got high volumes going through those small amount of suppliers. It means you've got negotiating power and leverage. It means you've got economies of scale and volume going through, and you should see that reflected in lower pricing. So really, you have to weigh that up and decide what you're going to accept and what you aren't in each individual market. Now, we'd probably say on average 3 or 4 payment methods would be about right. That's not scientific. That's just what we've observed. Again, it really does depend. Final point is these are changing significantly over time, particularly with the increased penetration of mobile payments. So 2 or 3 years ago, most people here probably never heard of Alipay or WeChat. Now in China, our clients in China, we see as much as 50% of all of the card transactions that they are seeing in China via the mobile payment apps of WeChat and Alipay. So it can change very, very, very fast. And really what we need to do is understand the trends and make sure we keep reviewing the payment methods we accept. Because ultimately, if you're paying the right, if you're accepting the right payment methods, then you're going to see higher conversion rates. The second point is on de-scoping the checkout process, and that is making your point of sale face-to-face or your website online as streamlined as possible to make it as easy as possible for people to pay. A key example of this is we had a client a few months ago who was accepting the CVV2 code, and that's the 3-digit code on the back of your card, and they were accepting the CVV2 code via blanking it out, like it would be for an online password, so you couldn't type it in. And they wondered why they were seeing lower acceptance rates than they would expect. So simply, really simple trick of the trade, don't blank out the CVV2 code. That meant that when people were typing it in, they were accidentally typing it wrong. They realized that they were typing it in wrong and they could collect it. Overnight, a higher acceptance rate, just from that one trick. Additionally, contextual commerce is coming in, and this is going to become increasingly prominent, I think, in future years. Now, my favorite example of that is for two friends on Facebook talking, and they say, we're going to go out tonight, we're going to go for some drinks, I'll get a taxi to yours, I'll get an Uber. Then all of a sudden, automatically the Uber app appears, and you can order an Uber straight away. And that is sort of an example of how companies can interact with each other, they can join together in order to maximize their conversion rates, in order to increase sales. So de-scoping the checkout process and just thinking about the way things are presented to the customers is vitally important. The next one is local acquiring versus pan-European acquiring. But I think it's more important than this. It's wider than this. I think it has more to do with where you're domiciling your business. I mean, an example of this, now I'll pick it out. Yeah, say you do an awful lot of business in Indonesia. And you might expect, if you're running it all out of one central office out of, say, the US, you might see that your acceptance rates in Indonesia are very low. That's likely to be because local Indonesian banks would prefer, or will have more likely to accept transactions from a domestic Indonesian entity. So obviously one potential solution to that would be to set up, obviously, a domestic Indonesian entity. Now, we accept it's more difficult than that when it comes to accounting rules and regulations and laws, etc. But we see a lot of merchants, they're in countries where they're selling an awful lot of goods, they're seeing very large decline rates, and there is a simple solution there. But the other thing is what's there, which is to do with acquiring. And what we have observed in recent years, and particularly recent months, is an increase in international acquiring. So up until a few years ago, most merchants, international merchants, they have a different acquirer, in every single market. We have a French acquirer, a German acquirer, etc. You probably know consolidation of the payments industry. Vantiv and WorldPay have merged. Nets has purchased Nordea. I mean, I could go on forever. There's lots of consolidation in the industry. A lot of acquirers are joining together. And that means that the international acquiring solution is becoming a genuine option for people. And that's great for merchants. It means you get economies of scale, which will be reflected in lower pricing. It means you're only having to negotiate one contract. It's brilliant. But, it potentially has an issue insofar as local issuers prefer local acquirers. I mean, a lot of issuers in a lot of countries, France is an example, the issuers still own the acquirers. So they prefer local acquirers and they're more likely to accept transactions from local acquirers. So, if you're thinking about introducing a pan-European or a multinational acquiring solution, great potential benefits, but you need to weigh it up against, the potential hit that it could have on acceptance rates. And, for some merchants, that is fairly significant. Point 4 then is fraud prevention, and that is about keeping good sales in and bad sales out. Now, a lot of merchants, I think now most large merchants have some sort of fraud prevention. Now that might be, internal fraud prevention with an internal fraud prevention team, or it might be external. You might have a fraud prevention provider, a supplier, and that sits on the POS. And I mean, what we would say about the external ones is you need to make sure you go through a robust procurement process. Some are much better than others, and some are more appropriate than others for different types of merchants and different types of sectors. So you need to go through that. But what we have noticed is merchants that do get it right with fraud prevention, the fraud prevention software that sits on the POS tends to be looked more favourably at by issuers. So they tend to have higher acceptance rates by issuers. There are also other little fraud prevention tricks you can use, and a favourite of mine is a ticketing merchant. A client of ours who they will send me email as soon as you purchase a transaction, and they'll say, it's gone through, but they won't send the ticket till half an hour later. And that half an hour window gives them the time to properly fraud scope that person, that consumer, to make sure that they're happy with that. And, again, little trick of the trade that, can be very helpful to, some merchants. Point 5 then is merchant category codes, and merchant category codes or MCCs, are classifications based on the goods and service that merchants sell. Now, there are 2 points here. The first is, a lot of the time, there will be more than one applicable merchant category code for any given transaction, or for any given merchant, sorry. So some of them are straightforward. I mean, if you're in online gaming, for example, your MCC is 7995, you can't do anything about that, it's 7995. In the apparel sector, for example, the clothing sector, there are plenty of different merchant category codes that are applicable. There's several of them. What we would encourage merchants that are accepting payments to do is test them out, have a look at them, find out what your peers are doing, find out what your competitors are doing. Ask your acquirer, am I using the optimal merchant category code? Ask an independent consultant such as us. You need that visibility. I mean, we had an example a couple of years ago of a client that changed MCC, didn't do anything else, and saw their acceptance rate increase by nearly 10%. Other slight caveat that with regards to changing MCC is in some countries, the United States is one of them. There are different interchange categories depending on your MCC. So you might move into a different interchange category that may or may not may decrease or increase your interchange bill and your costs, and obviously that has to be weighed up against the impact on acceptance. So it is kind of dynamic. The second point is many merchants, particularly very large merchants. I mean, you get many large supermarket chains that have fuel stations on site, for example, and many of those have obviously 2 different business lines and potentially 2 different merchant category codes. Now, the relevance for that is a lot of them would only use one MCC, and what we find more often than not is that using different merchant category codes based on your different business lines is more likely to maximize acceptance. So again, further consideration there. Point 6 then, scheme rules vary by market and you need to understand the markets you're in. Now, I mean, this might be somewhat counterintuitive because, Visa and MasterCard are global schemes, they're operating in pretty much every country in the world, certainly the significant ones, and you'd think that they just have scheme rules and you just live by those. What we find is they actually vary significantly by country. In some countries, for example, Visa's account updater and MasterCard has an equivalent is mandatory. In other countries, it's not. An account update is obviously when somebody's card detail change would automatically update those for, say, recurring billing. But yeah, very, very different scheme rules. Also, some countries have local card schemes, our own local rules, and again, you need to be aware of those. You need to comply with those. If you don't comply with those, you likely have an impact on acceptance rates. The final point to do with that, and it leads us nicely into point 7 here, is to do with cardholder authentication, and I want to particularly emphasize 3D Secure here. So in some countries, and India is one of them, 3D Secure is mandatory. So if you don't use 3D Secure, and a bit of info, 3D Secure is when you finished your payment online, your transaction's gone through, then it will send you to your bank's portal, you'll type in your online banking password, then the transaction will go through. Some countries it's mandatory. In India, it's mandatory. Natural thing with 3D Secure is you've got a trade-off. You've got a trade-off between dropout, losing transactions, churn on one hand, and then obviously decreased fraud on the other. And the decision about whether to turn on or off 3D Secure in any given country is a really, really important one. And if you're a merchant operating internationally and you apply generic standards across all your estate to 3D Secure, you might end up in some countries with having a huge amount of dropouts, and in other countries, or in other countries having a huge amount of fraud. We've emphasized this here. So we have a number of different countries here, and these countries have very, very different impacts. 3D Secure has a very, very different impact on conversion for all these countries. Now, I would imagine that if you were to guess which ones it has a positive impact and which ones it has a negative impact on, you might try and categorize them according to region or size of economy or various factors. That's absolutely not. There's no real pattern to it, and we find that interesting. So here we look. A lot of countries it has a positive impact. So we've got India, we've got Qatar, we've got Vietnam, we've got Russia, we've got the UK, and we've got the Czech Republic have a positive impact. In other countries, 3D Secure has a negative impact. It's not as straightforward as that, though. I mean, some countries like India has a hugely positive impact. Some countries it's small. Again, it can differ by merchant and by sector. I mean, some sectors, for example, where you need a really quick throughput, sort of bang, bang, bang at the point of sale, then, you might not want 3D Secure because it's going to slow down, so there'll be a large dropout. Other sectors for maybe very high transaction values, it can make a big difference. Also, it's changing over time as well. So what we are generally seeing is a lot of these reds being converted into greens as some markets get more and more accustomed to 3D Secure. In some markets, though, I think it potentially won't ever take off. In the US, for example, I was in Florida last week at a conference speaking to a lot of merchants, and they're very, very skeptical about 3D Secure. Doesn't really seem to have been successful in the US. In other countries, it's been really, really successful. Now, there are a few other tricks you can use with 3D Secure. You can use what we call dynamic 3D Secure, and my favorite example of this is a online gaming company, a client of ours, and what they would do is they would switch 3D Secure off when they had, say, a really important live football game or a live horse race or something, a really big sporting event. They'd switch it off because they need that live betting again, that bang, bang, bang. But they'd switch it on, for quiet times. So again, you can be dynamic with it, per sector. Also, 3D Secure is changing. So from, in the next few months, the next couple of years, 3D Secure version 2 will become active. And 3D Secure version 2 is a little bit more dynamic than 3D Secure version 1. What they'll be able to do is look at the profile of the customer. So if you've got a customer who always orders online, they're shopping at 10 a.m. from a certain supermarket on a Saturday, they'd say that transaction is flagged as fairly safe, and they wouldn't turn that on. They'd let that one go through. If, for example, you ended up with an elderly person that's buying heavy metal concert tickets at 5 in the morning in the other side of the world to where they are, then you would flag that transaction as potentially suspicious because it's not consistent with the normal behavior of the consumer, and you would turn 3D Secure on there. So 3D Secure is an interesting one. There's no right or wrong answer, but you need to understand the dynamics that dictate dictate that decision. Interestingly, with authentication in general as well, obviously I mentioned I was in Florida last week, and I spoke to people from the Secure Remote Payments Council, and they have a genuine hypothesis that the general system, be that 3D Secure version 2, anything to do with the way it works at the moment, is not optimal, and what they're campaigning for is an open, secure messaging standard. And they think that should help sort of address perhaps the dominance of the global card schemes and introduce maybe more competition and innovation in the space. So it's very possible that the questions that we're answering here that are relevant for today may not be relevant in 5 or 10 years time. So again, we need to keep, it's an ever-changing industry, payments. We need to keep active with what's going on. We need to really make sure that we keep up to date with what's happening. Point 8 then is knowing exactly why each decline occurs. So what you should be doing is you should be asking for reason codes from your acquirer. You need to find out if there is a problem with acceptance rates. Often it's one particular country or one particular issuer within that country that has a problem with acceptance rates. Find out why that is. Ask them, get that information. Also, if a reason code, sometimes what they'll give you is generic. It doesn't tell you anything. You need to really, really get down into detail and find out exactly why those transactions aren't being accepted. And that leads nicely into the final point, which is about leveraging your acquirer's experience to optimize your results. Particularly if you have local acquirers, those acquirers are very likely to have relationships with the issuers. They might even be owned by them. And it's very likely that if you let them know that you've got a problem, they look into it, they find out what the problem is, what the issue, what the particular issue is that they have a problem with. They've got a relationship there, they speak to them, they find out why, and they can deal with it. And again, you'd be shocked how often it's just as simple as that. It's just as simple as getting your acquirer to pick up the phone and speak to them. A lot of the time, the acquirers just won't think about doing it. But yeah, this is mutually beneficial. I mean, it works for the suppliers if the transaction goes through, it works for the merchants. I mean, even if a transaction is secure, it works for the issuers. It's just a case of, the merchant needs to make sure that they are active and that they push to get their acquirer to do what they need to do in order to maximize their acceptance. So that rounds off the 9 points. I mean, what I would say is there's limits to what we can achieve in 15, 20 minutes. I mean, hopefully here, I've given you a lot of sort of easy wins and low-hanging fruit that, should enable you to hopefully identify real pain points and address them, in the short term. But what I would say is, optimizing acceptance rates is far more complicated than that. It requires, a lot more work. It requires you to be nimble, to keep up to date with industry changes, to be dynamic, to really understand the dynamics, and to, as things change, make sure that you really, really, really keep up to date with it. But as we can see, if you get it right, you can increase your revenue, you can increase your margins, and you can increase your profits. So it's absolutely worth thinking about. Thank you very much for listening. I'm now happy to answer any questions you might have.